Today, we are shifting gears a little bit. We are turning on what we're calling Global Pulse.
A special edition.
It's a special edition because, frankly, the feedback loop demanded it. We had a listener reach out who was, and I think I'm quoting here, exhausted by the surface-level skim.
I know exactly what they mean.
You know the drill, right? 30 seconds on the Dow Jones, a quick flash of a percentage point, a nod to the Federal Reserve, and then immediately pivoting to the weather or sports.
It leaves you hungry for the mechanics. It's like being told the car is broken, but never being allowed to pop the hood to see which belt snapped or what's leaking.
Exactly. That's a perfect analogy. They wanted us to go beyond the headlines.
Yeah.
So we accepted that challenge. Our mission today is to really anatomize the inflation situation.
Get the scalpel out.
We are. And when I say anatomize, I mean we are not just reading the press release. We have pulled the full raw data stack for this deep dive. The December 2025 Bureau of Labor Statistics microdata release.
The really granular stuff.
Oh, yeah. We've also got some incredibly dense historical notes from the Federal Reserve looking at the 1970s versus today, and a set of complex working papers from the Bank for International Settlements, or BIS.
Which is really where you find the signal and the noise. The headlines, they tell you the weather for today. The microdata and the BIS papers, they tell you about the climate change.
Is it climate change? Okay, I like that. So let's start with the number everyone sees, the headline number, the big one. According to the December 2025 release, inflation over the last 12 months hit 2.7%.
Which, historically speaking, sounds fine.
It does. It sounds almost normal. It sounds like problem solved, mission accomplished, let's all pack up and go home.
Yeah.
But looking at the notes you made in the margins of this report, you are clearly not in the mission accomplished camp.
I am definitely not, no. Because that headline number, that 2.7%, it almost acts like a camouflage.
Camouflage.
Yeah, it masks a much, much nastier surprise if you actually, open up the hood, like we said. It creates this aggregate view that hides severe pain points for specific people. It's what I call the tale of two bills.
Okay, let's unpack this. What do you mean by two bills?
I'm talking about the massive divergence between the bill you pay to get to work, your mobility, your gas tank, and the bill you pay just to exist in your own house.
Okay.
If you look at the microdata for energy, we aren't seeing a single trend. It's not one story. We are seeing two completely contradictory economic stories playing out at the exact same time.
I saw this in the BLS report, and it was genuinely confusing. Gasoline is down.
Significantly. Gasoline is down 3.4% over the last 12 months.
Yeah.
Which is, a decent drop.
It's noticeable.
For sure. And if you look at just December alone, before they do the seasonal adjustments, which, smooth out the data to account for holiday travel and weather and all that.
Right.
Before that, gasoline prices tanked 5.3% in a single month.
Wow. In 1 month. That feels like tangible relief. That's money back in your pocket at the pump immediately. You feel that right away.
It is. It's real. But then you go home, you finish your commute, you walk in the door, you turn on the lights, or you kick on the furnace because it's December. The cost of electricity, it hasn't dropped. It surged 6.7%.
Ouch. So the drive home was cheap, but actually being home is getting much more expensive.
And it gets worse. Utility piped gas service, basically the natural gas used for heating most homes, for water heaters, for cooking, is up a staggering 10.8%.
10.8%. That is double-digit inflation in a basic absolute necessity.
It's a huge number.
So on one hand, the global oil market is giving us a break, but the infrastructure, the actual wires and pipes physically connected to our houses, is charging us this massive premium. Why? Why the split?
It highlights a core economic distinction that is so often missed in the headlines. Gasoline is a commodity. It's priced globally.
Right. It's based on Brent crude and OPEC and all that.
Exactly. It fluctuates wildly based on geopolitics, shipping lanes, refinery capacity in Texas. It's incredibly volatile. It responds to global supply shocks instantly, but electricity and piped gas,
That feels more local.
those are services. They are regulated utilities. They involve what economists call sticky infrastructure costs, maintaining the grid, replacing old pipes, paying the wages of technicians. When those prices go up, they rarely come down quickly. They are structurally higher.
So the headline number of 2.7% might be statistically accurate, but if you're someone who doesn't drive much, say a retiree or a remote worker,
Right.
but you live in a drafty house in a cold climate,
then that 2.7% is effectively lying to you about your personal inflation rate. Your actual cost of living is rising much, much faster than the average because your personal basket is heavily weighted toward heating your home, not driving your car.
You are feeling a 10% inflation rate in your primary expenses, while the news is telling you everything is fine, it's under 3%.
And you think you're going crazy, but you're not. The data proves your experience is real.
This brings us to the next sector, which I've started calling the food aisle autopsy.
I like that.
Because the divergence isn't just in energy, it's right there in the grocery cart, too.
Yeah.
And I found something in the data I'm calling the omelet index.
The omelet index. Okay, break that down for me.
If you love breakfast, specifically if you love eggs, you are having a fantastic year. Egg prices crash. They are down 20.9% over the last year.
20%. That is a massive relief for shoppers who really rely on that cheap protein, you know?
Absolutely.
And that is a perfect example of a supply shock resolving itself. We had the avian flu issues in previous years, flocks were culled, supply just plummeted, and prices spiked to crazy levels.
I remember that. It was all over the news.
Now flocks have been rebuilt, supply is back, and prices collapsed. That is the market working exactly as it should. It's a classic commodity cycle.
But, and there's always a but in this report, you can't just live on eggs.
No. And if you look right next to the eggs in the cooler, the broader category for meats, poultry, and fish is still up 3.9%.
So the main protein, the center of the plate for dinner, is still exerting upward pressure.
For sure. The supply chain there is tighter. Labor costs at processing plants are higher, and feed costs are still working their way through the system. It's a much more complex chain than just eggs.
And then there's what I'm calling the treat tax. This is what really stood out to me in the split between eating in and eating out. Food at home, so groceries, is up about 2.4% manageable, but food away from home, restaurants,
Up 4.1%.
and it gets even more specific. Full-service meals, so sitting down with a waiter, getting the menu, the whole experience, are up 4.9%, almost 5%.
That tracks perfectly with what we were just saying about services versus commodities. It's the same logic.
How so?
When you buy a steak at the grocery store, you are mostly buying a commodity. The price is determined by the cost of the cow, the transport, the butchering.
The raw material.
Exactly. When you buy that same steak at a restaurant, you are buying the cow, sure, but you're mostly buying labor. You're buying the chef's time, the server's time. You're paying for their commercial rent, their electricity, their insurance. You're buying the service.
You're buying the experience economy.
You're buying the experience economy. And the experience economy runs on people. Wages in the hospitality sector have had to rise to attract workers back post-pandemic. Rents on commercial spaces have risen. So the price of the meal has to rise to cover all those inputs. You are paying for the atmosphere and the service, and both of those things are getting more expensive.
So the takeaway for the listener here is pretty clear. If you want to beat inflation, you need to learn to cook your own eggs and your own steak. The spread between the grocery store and the restaurant is widening.
Essentially, yes. You are paying a premium for someone else's labor. It's becoming a kind of luxury tax on convenience.
Let's move to the really sticky stuff, the services. We mentioned utilities and restaurants, but the BLS report highlighted some other areas that are, well, they're concerning.
The core index, that's the one the Fed watches closely, everything minus the volatile food and energy, that rose 2.6%. But within that, the devil is absolutely in the details, and shelter is the big one. It's the elephant in the room.
Rent and owner's equivalent rent, always a controversial one.
Always. Shelter costs in general rose 3.1%. Now, shelter is massive. It makes up about a third of the entire CPI basket.
A third.
Yeah. So when shelter is stubborn, inflation is stubborn. It acts like a heavy anchor, preventing the overall number from dropping further. It doesn't fluctuate like gas prices. It moves like a supertanker. It takes a long, long time to turn around.
But there was a real shocker in the data that wasn't shelter. I mean, we expect shelter to be sticky. This one was in the medical field.
Medical care. Specifically hospital services. They surged 6.6%.
That is a huge number for a single year. A 6.6% increase in the cost of going to a hospital.
It is huge. And again, think about the inputs. Hospitals are incredibly labor intensive. They require highly specialized labor nurses, technicians, doctors. There has been a chronic shortage of healthcare workers since the pandemic.
Burnout has been a major issue.
A massive issue. So wages had to go up just to retain staff. Plus, hospitals use a ton of specialized equipment, pharmaceuticals, and a huge amount of energy. This 6.6% jump is a clear signal that the service sector is running hot and passing those costs directly on to patients and insurers.
And speaking of running hot, Did you see the numbers for recreation?
I did. That was a record breaker, wasn't it?
It was. The index for recreation services rose 1.2% just in the month of December. And the report notes that is the largest single one-month increase ever reported for that index, going all the way back to 1993.
Which tells us something fascinating about the consumer, doesn't it? Despite all these price pressures on necessities, people are still spending money on having fun.
Demand is incredibly resilient.
It is. Whether it's concert tickets, gym memberships, streaming services, companies have pricing power. They are raising prices, and we are, for the most part, paying them.
And then there's the volatile world of travel. Airline fares. This one was all over the place.
A classic case of volatility. Over the full year, airfare is actually down 3.4%. So year over year, flying is cheaper.
Which is surprising.
It is. But in December alone, fares jumped 5.2%.
It's a roller coaster. You don't know what you're getting month to month.
Exactly. And that volatility makes it really hard for consumers to plan. But if you zoom out from the monthly noise, the trend in services, whether it's hospitals, recreation, or rent, is consistently upward. That's the sticky inflation that keeps central bankers up at night.
Why is that?
Because you can fix egg prices with more chickens. You can fix gas prices with more oil production. You can't fix hospital prices or rents nearly as easily. It's a much deeper, more structural problem.
Okay, before we get into the why of all this, the deep structural causes you mentioned, I want to pause and actually look at the instrument itself. We throw around CPI and 2.7%, but I feel like we often treat it like a physical measurement, like checking the temperature outside. But it's not, is it?
No, it's not a thermometer. That's a great way to put it. It's a statistical construct. It's a model of reality, not reality itself.
Right. It's a basket.
Exactly. The Bureau of Labor Statistics constructs this theoretical market basket of goods and services. And to do it, they collect about 80,000 price quotes every single month.
80,000. That's massive. I
Wow.
can't even get my head around that number.
It is. They have people on the ground and systems online getting data from thousands of retail stores, doctors' offices, rental units, websites. They are literally checking the price of a specific loaf of bread, a specific pair of jeans, a specific dental cleaning. It is a massive data harvesting operation.
And then they weight all those prices.
Correct, because a 10% rise in the price of salt doesn't matter as much to your household budget as a 10% rise in the price of rent. So they weight the items based on how much the average urban consumer spends on them, based on detailed expenditure surveys.
Now, one thing that always gets listeners riled up, and I see it in the comments all the time, is the substitution effect. It sounds like cheating to a lot of people. Can you explain that?
It's not cheating, but it is one of the most controversial parts of the calculation. It's based on the economic idea that consumers are rational actors.
Which is a big assumption to
Big-
begin with.
A very big assumption. The theory is that if the price of steak skyrockets, you don't just keep buying the same amount of steak and go bankrupt. You switch to chicken. You substitute.
So the index assumes I'm downgrading my lifestyle to cope with prices.
Or, as an economist would phrase it, you're adjusting your consumption patterns to maintain your utility, your overall level of happiness within your budget. The index tries to measure the cost of maintaining a certain level of satisfaction, not necessarily the cost of buying the exact same physical goods year after year.
But I see the criticism. If you really love steak, you don't feel equivalent swapping it for chicken. You just feel poorer.
That's the heart of the critique. It can understate the true feeling of inflation because it assumes you're perfectly happy with the substitution, when in reality it feels like a loss.
There's another one of these adjustments they do called hedonics, right? For quality changes.
Yes, hedonic quality adjustments. This one is also tricky. The idea is if a new iPhone comes out and it costs the same as the old one but has a much better camera and a faster processor.
You're getting more for your money.
Exactly. So the BLS might say the price has actually dropped in quality adjusted terms. You got more phone for the same number of dollars.
Which makes perfect sense to an economist, but to a regular person looking at their bank account, $1,000 is still $1,000 leaving their wallet. It doesn't feel like a price drop.
Precisely. And that disconnect is why people often feel the official inflation rate is lower than their lived experience. The model is capturing this abstract concept of economic utility, while the consumer is looking at the cold, hard cash.
I want to zoom out for a second. We're talking about percentages, 2.7%, 3.4%. That's the rate of change. It's the speed the car is moving. But I want to look at the odometer for a minute. The total distance traveled.
The index level. Yes, this is so important.
The BLS data says the unadjusted CPIU index level for December 2025 is 326.03. The baseline was set to 100 back in the early 80s, 1982, 84.
Right.
So roughly speaking, a basket of goods that cost $100 back then now cost about $326.
That's the math. It shows the cumulative erosion of purchasing power over 4 decades.
But let's just look at the last 10 years, or even the last 5. Even if inflation is slowing down to 2.7%, prices aren't going down. We aren't seeing deflation.
No. And this is the price level argument that gets lost in all the headlines about the inflation rate. Think of it this way. The car was speeding at 100 miles an hour during the peak inflation years of the post-pandemic shock.
Right.
Now it's slowed down to a more manageable 27 miles an hour. But the car is still moving forward. It is not backing up. We are miles and miles away from where we started pre-pandemic.
So when people say, inflation is down, why is everything still so expensive?
That's the answer. They're not crazy.
They are not crazy at all. They are correctly observing that we have reached a new, much higher plateau for prices. Those prices are permanently elevated. Unless we have a severe, catastrophic deflation, which causes a whole host of other economic disasters like mass unemployment and debt defaults, those prices are here to stay.
We're just supposed to get used to them.
We are acclimating to a new altitude. The air is thinner up here.
Okay, we've covered the what. We've dissected the basket. We've looked at the price level. Now I want to get into the why. And I don't want the easy answers.
You mean you don't want to just blame supply chains or corporate greed and call it a day?
Exactly. Or just money printing. The research stack you brought today suggests there are darker, more structural drivers at play. Things that are much harder to fix than just clearing a port blockage in California.
There are. And this is where we get into the really fascinating and frankly more unsettling economic theory. Let's start with the age structure puzzle.
This comes from the BIS papers, specifically the work by Juselius and Takats.
Correct. For a long, long time, standard economics basically ignored demographics when thinking about inflation. It was just assumed to be a neutral factor in the long run.
But that's changing.
It's changing fast. The theory here, backed by a lot of data, is that inflation is highly correlated with the age distribution of the population.
How does that actually work? What's the mechanism?
It breaks people into 2 basic groups: dependents and producers. Dependents are the young and the old. They consume stuff, food, healthcare, housing, education, but they don't produce goods and services for the market economy.
Okay, and producers.
That's the working age population. They produce more than they consume, on average. They are adding supply to the economy. They're building cars, writing software, providing services.
So if you have a lot of working age people relative to dependents, you have an excess supply of goods and services relative to demand.
Which is deflationary, or at least disinflationary. It keeps a lid on prices. And that was the story of the last 30 or 40 years.
The good times.
You could call it that. We had the baby boomers in their prime working years, and we had the integration of China and Eastern Europe into the global labor market. It was a massive one-time boost to the world's supply capability. We had a deflationary dividend. Now, the boomers are retiring in droves. They are flipping from the producer column to the dependent column. They're still consuming, especially healthcare, as we saw in the microdata with that 6.6% surge, but they aren't producing anymore. They aren't driving trucks or writing code or managing factories.
So that creates excess demand relative to the economy's productive capacity.
Excess demand and, crucially, reduced supply of labor, which is a recipe for structural inflation. The BIS research suggests that an increase in the dependent cohort, the ratio of non-workers to workers, is structurally inflationary.
They actually had a specific data point on this that blew my mind when I read it.
They did. It was a powerful finding. They found that an increase in the 10-14 age cohort, just as an example of young dependents, by 1 percentage point increases inflation by approximately 0.05 percentage points over the long run.
It sounds small.
It sounds small, but when you apply that across a whole shifting population, across millions and millions of people moving from one age bracket to another, it adds up to a significant and persistent upward pressure on prices.
So the deflationary dividend we enjoyed for decades is gone. It's been spent. And now we are entering a structural inflationary period just because we, as a society, are getting older.
It's a powerful headwind that central banks can't really fix with interest rates. You can't raise interest rates to make people younger. You can't print more 35-year-old workers.
That is a deeply unsettling thought. And it leads us to the second driver. This one sounds like a fringe conspiracy theory, but it's actually gaining traction at places like the Richmond Fed.
the fiscal theory of the price level.
The FTPL. Yeah, it's moving from the fringes to the mainstream very quickly. The standard view you learn in Econ 101 is that the Fed controls inflation by controlling the money supply and interest rates.
Right. The Fed is the thermostat for the economy. Raise rates, cool things down, lower rates, heat things up.
But the fiscal theory says, not so fast. It argues that the overall price level isn't just a monetary phenomenon, it's actually determined by government debt and the public's perception of the fiscal outlook.
The government's credit card, essentially.
In a way, think of the government like a corporation. The currency, the dollar, is kind of like its stock. The government debt, the bonds, are its liabilities. If the public, you, me, the bond market, everyone starts to believe that the mountain of government debt will not be repaid by future surpluses.
Meaning, if we think the government is just going to print money to pay off its debts rather than raising taxes or cutting spending,
Then the debt becomes bad paper. It loses its value, and people try to dump it. They sell their bonds and try to buy real things instead. Cars, houses, goods, services. Get me out of this currency. Get me into real assets.
and that rush to buy real things drives up their prices.
Exactly. It drives up the price level. So the terrifying implication of FTPL is that if the fiscal house isn't in order, if the deficit is out of control and the debt is on an unsustainable path, the Fed can raise interest rates all it wants, but it might not be able to kill inflation.
Monetary policy becomes ineffective.
It becomes less effective. It's like trying to bail out a boat with a teaspoon while there's a giant hole in the bottom. The theory connects the government's budget directly to the price of your milk. It basically says inflation can be a fiscal phenomenon, not just a monetary one.
That is heavy. It implies the central bank is not omnipotent. Their power has limits set by politicians.
It connects the bigger picture. It says that persistent inflation isn't just a technical error by the central bank. It can be a reflection of the entire government's solvency and credibility.
Okay, let's hit the third driver. This one is less about government and more about our own brains. Adaptive learning.
This comes from the BIS papers again, specifically work by Hortas and others. It challenges the old-school idea that we are all rational expectations machines who perfectly understand how the economy works.
I could personally confirm I do not perfectly understand the economy, so I'm with them so far.
Most people don't. Standard models often assume we all know the Fed's inflation target is 2%, and we believe them and we act accordingly. But this theory says agents, that's just a fancy word for consumers and businesses, we act more like amateur econometricians.
Meaning what?
Meaning, we don't know the future. We use simple rules of thumb to forecast what's coming, and we adjust those rules based on our past errors.
We look in the rearview mirror to see what's ahead.
To a large extent, yes. And here is the key concept from this research. Sticky expectations, or the more technical term, hysteresis.
Hysteresis. It sounds like a medical condition.
It's more like a scar, an economic scar. If you live through a period of high inflation like we just did, you learn that prices go up. That experience gets baked into your brain. Even if the reality on the ground cools down, your brain is still stuck in that high inflation mode. You expect the next price hike is just around the corner.
So businesses keep raising prices because they expect their own costs to go up. It's preemptive.
And workers keep demanding higher wages because they expect their rent and their grocery bills to go up. It becomes a self-fulfilling prophecy. The expectations of inflation become a driver of actual inflation.
It becomes sticky.
Exactly. And it takes a long, sustained period of low, stable inflation to unlearn that behavior, to heal the scar.
So we have aging populations pushing prices up, we have massive government debt potentially pushing prices up, and we have our own scarred brains pushing prices up. It makes 2.7% seem like a miracle that it isn't higher.
It puts the resilience of the economy in perspective, for sure. It suggests the underlying current, the structural tide, is flowing against low inflation right now.
I want to look at how we stack up against the rest of the world. Because, as we said, the U.S. is sitting at 2.7%. But the prompt mentioned an OECD average of around 4.5%.
We are doing significantly better than many of our peers, particularly in Europe, which struggled much more with the energy shocks from the war in Ukraine.
Why the divergence? Why is the U.S. an outlier in this case?
Well, a big part of it is our energy independence, for one. But another key concept from the BIS is trade openness. The idea is that countries that are more open to global trade can effectively import disinflation.
We buy cheap stuff from elsewhere, and it holds our prices down.
That's the simplest way to put it, yes. If we can buy cheaper manufactured goods from a country with lower labor costs, that directly dampens our inflation numbers. But economies that are more closed or are suffering from new trade barriers and tariffs, they face domestic price spirals. They are trapped in a closed loop with their own high costs.
And the U.S. is a massive importer.
One of the biggest in the world. We bring in cheap goods constantly, and that acts as a safety valve for inflation.
And the dollar itself has to play a role here too, right? The strength of the dollar.
A huge role. This is called the exchange rate pass-through. When the dollar is strong, which it generally has been relative to other major currencies, it makes all imports cheaper for us. We
Yeah.
can buy French wine or Chinese electronics or German cars with our strong dollars, so the price in dollars for those goods stays lower.
Whereas countries with weak currencies have the exact opposite problem.
The exact opposite. They have to pay more and more of their own currency for everything they need to import, specifically oil and other commodities which are priced in dollars globally. So their inflation gets driven up by their weak currency. In a way, the U.S. is essentially exporting some of our inflation to the rest of the world via the strength of our currency.
Let's bring this all back down to earth. We've talked about the aggregate numbers, the basket, and we've talked about the high-level economic theory. But I want to close by talking about the human impact, the inequality of prices.
This is the so what. For the average listener, this is what really matters.
Who actually pays the price for this kind of inflation we're seeing?
When you go back to that BLS microdata, the inequality is just stark. It's almost K-shaped. We talked about the shelter trap. Shelter costs are up 3.1%. Energy services, heating, and electricity are up anywhere from 7% to almost 11%.
These are not optional purchases. You have to live somewhere. You have to keep the lights on, especially in winter.
Exactly. These are non-negotiables. And for lower-income households, these two categories, rent and utilities, make up a massive percentage of their monthly spending. They are disproportionately crushed by these specific increases. They don't have wiggle room in their budget.
Contrast that with the airfare drop we saw, down 3.4% year over year,
Yeah.
or the slowing of inflation for, say, electronics or furniture.
Right. If you have a higher income, if you have disposable income, you're the one benefiting from those trends. You're flying for vacation, you're buying a new TV, your personal inflation rate might feel quite low, maybe even negative in some months. You see the airfare deal and think, hey, things are getting better.
But if you're a family of 4 in a cold state struggling to make rent and pay the heating bill,
Then a headline number of 2.7% feels like an insult. It feels like a lie because your reality is closer to 10% or more. And this explains so much of the disconnect between economic data and public sentiment. The economy on paper can look good, but if inflation is concentrated in the absolute necessities, people feel terrible.
it's a completely bifurcated reality.
It really is, and that creates enormous social and political friction.
So, we're coming to the end of our deep dive. What do we watch next? Is the fight over? Is 2.7% victory?
The Federal Reserve would say, very cautiously, that there is modest further progress toward their 2% objective, but they are very, very careful to say that risks remain. They are not popping champagne corks at the Eccles building.
And based on the Richmond Fed research and the BIS papers, the biggest risk is de-anchoring.
That's the danger zone. It connects right back to that adaptive learning and the economic scarring we discussed. The danger is what they call second-round effects.
Walk me through that. What does a second round look like in the real world?
Round one was the initial shock. The pandemic broke supply chains, energy prices spiked, we survived that. Round two is the human response to that shock.
Okay.
If workers look at that 10.8% utility gas bill and the 6.6% hospital bill and they go to their boss and say, look, I need a 10% raise just to break even.
And if the boss gives it to them because they need to retain workers?
Then the company has to raise its prices to cover the higher wage costs. And then the worker, seeing prices rise again, needs another raise next year to keep up. That is the dreaded wage price spiral.
That's the 1970s all over again.
That is what central banks are absolutely terrified of. Once that spiral starts, it is incredibly painful and difficult to stop.
And that's why they're watching the services sector so closely.
Exactly. Commodities like eggs and gasoline are volatile. They're noisy. They bounce around. They can drop as fast as they rise. But services, inflation hospitals, rent, car repairs, that is sticky. It's hard to kill. If that starts spiraling, the 2.7% we see today will look like the good old days very, very quickly.
That is a very sobering thought to end on.
It is. But it's the reality of the data. We are at a critical pivot point. The easy part of the inflation fight is over. Now comes the hard part.
So here's my final thought for you, the listener, to chew on.
We've talked about how demographics, aging populations are structurally inflationary. We've talked about how high levels of government debt can be structurally inflationary. If these are powerful long-term trends that will be with us for decades, is the target of 2% inflation even realistic anymore? Or are we chasing a ghost from a different economic era?
That is the multi-trillion-dollar question, isn't it? Are we trying to force a 2020s global economy into a 1990s mold? And what happens if it just doesn't fit?
Something to mull over while you're paying that next electric bill.
Indeed.
Thank you for joining us on Global Pulse. This was a heavy one, but we hope it gave you the anatomy of the situation you asked for.
It's all there, right in the microdata. You just have to look.
If you want us to do a deeper dive specifically into the fiscal theory of the price level, because I know we just scratched the surface there, or if you want to explore the demographics angle more, drop a comment below.
We'd love to unpack those further.
Yeah.
They're both huge topics on their own.
Don't forget to like, share, and subscribe for more deep dive research. We'll see you on the next deep dive. Stay curious.